Welcome to Classic Value Investors and Microcap Explosions. This is Mariusz Konieczny. Today we are talking with Robert Bugbee from Scorpio Tankers. Robert, thank you very much for joining me.
Thank you very much, Mariusz.
Robert, it's been a while since we did this, so I'm sure there's a lot of updates that you can update us on. So my usual questions to you would be rates, destocking, things like this. So just go ahead and start it with whatever order you would like.
Sure. No, it has been a while. It's been, I think it may have been all the way back since October. Since then, the stock price itself has been recovering, trending to recovery, and there's been, in the last few weeks since we've turned the year, especially since we've got vaccines, there's been considerably more investor interest. And we're pretty busy on that front. We have a number of webinar conferences, in addition to taking numerous one-on-one investor calls. So one of the biggest changes is that, we've really got back the institutional interest, not just in Sting, but I think in tankers generally, as people see the world opening up. The rates, obviously, in the fourth quarter and even now are not great. But there's certainly, if we look at the indexes, I can't really guide to too much at the moment because we're so close to earnings. But if we looked at the the indexes that we have said time and time again are most relevant to Scorpio Tankers, which is really the Clarkson's index. We can see that it's certainly within the tolerance level that we were indicating back on our November call in terms of operating cash and liquidity. We believe that we have to get through to this right at the end. We're seeing right now, obviously we're seeing great things on the supply. We're seeing, continued very little new building ordering. The actual future supply side is if it was great this time last year, it's, whatever word you want to use, fantastic now. I mean, the competitors' fleets have aged another year. We're now into that first year where a considerable number of product tankers turn 16 years old and find it much harder in the premium trades. And the order book itself, in terms of number of vessels, has declined. In addition to that, we're seeing a lot of signs that general new building pricing is going to be moving upwards. There's been a lot of activity in other markets around us, containers, for example, gas. We're starting to see, with the recovery in the dry bulk market, more interest in dry bulk orders, and most importantly, the yards have consolidated a little bit more in the last 12 months, and they've got inflation under their costs, and that's sort of helping in terms of the assets. And then now, rather than another big difference, probably a major difference to when we last spoke, is that customers are no longer redelivering vessels. They're actually out there looking to re-lengthen their books. So there's a number of charter activity going on in the product market, both by the oil majors and by traders and by the stronger owners. And that's very good. And that's largely simply because we're seeing inventories in products have virtually normalized. There's very little capacity out, whether it's in onshore or on the actual water itself. The product market is a little bit more advanced than the crude oil market in that there's not any really surplus capacity.
And what about the refiners? I know we talked before about some closings. How does this look?
That's actually probably that's a big plus since the last time we spoke. The Shenzhen refinery in the Middle East is up. It's come forward. It had suffered a number of delays. Many people thought that it could be delayed further, but it's actually already up. already loading its its first cargoes coming up this week, and the next big refinery coming up in the second quarter out of the Middle East is on schedule too. So as far as the product tanker market is concerned, that's fantastic. Just in those two areas, you're going to be adding 1 million barrels of export production that has to be sort of shipped. When it comes to closures, we've seen those closures in Australia. We're seeing the closures coming in Europe, and more inefficient ones in the States. So the refinery aspect is extremely positive going forward, and I think that's the effect of that is a little bit masked at the moment, just simply because we've been at that sort of max lockdown stage. The activity though will come in instantly. I mean, this week, for example, with the combination of just people driving more in the States as things get better, and tremendous cold in the East Coast, we suddenly started getting big bookings into New York. I mean, we fixed 3 MRs this week into New York from Europe, and we also fixed 1 big LR2. And, that's been the first of those movements for months and months and months. So I think this combination between inventories lower, the older refineries closing is there. It's going to start to take effect as the markets open up itself. It's already taking effect in the sense that the Asian markets have been so much stronger in the first half of this year than the markets west of Suez Canal.
Robert, talking about the stock price of Scorpio Tankers, obviously, as you said, we've been seeing the stock price go up significantly from the lows, and I was wondering, a reader asked me about your call option buying, and I was wondering, why do you choose the call option versus buying the common shares directly?
Sure. I think there's a bit of a misunderstanding in that, I may not have been, buying stock in the name of Robert Bugbee, but I'm a partner and I'm a significant shareholder of Scorpio Holding Company, and we've been buying through that vehicle as insiders. I think virtually through the whole summer we got blocked out in, as we were coming into the earnings in November, but the series of announcements there buying the stock at 10, 11, 12, 13. So it's not a either or. I have through my own ownership and through Scorpio Holdings a significant amount of Scorpio Tankers stock, and as I said, I've effectively been adding those every time you see Scorpio Service Holding. That's part myself, buying stock too. I think now, I think that as last year, or the year before, we had something that was mispriced, and that move the stock had through the late 20s into 40 was going to be abrupt as people turn the year pre-COVID. And right now, for better or worse, I think that the movement I see, this is a personal opinion, so this is not investment advice or anything like this. It's to help you understand that question, which I think is fair. I think it's a really quick step up to $25 a share, and all that requires is the first step, which is what you're seeing right now and been seeing in November, that you have vaccines, the hope of opening up. That news is getting better and better by the day. I mean, by the time Scorpio reports earnings, we're likely to have been, through over 60 million vaccinations in the United States. That's turning the position. Will turn again towards, it's only when now we start to increase that demand side, whether it's going to be the world doing it in March, April, May. It's only when OPEC starts to turn the tap to reopen and increase. It's only when the IEA starts to revise upwards its forecast for consumption. And we know that the product market will lead that consumption, because you have to get the products in its place. So if you could tell me now, a vaccination expert, and you could tell me, what the vaccinations are going to be like in April, or you could tell me when airlines will start to book more flights, you can proceed that to when products will lift. So we have I think that it is two levels. You take to 25, then you go to 40, and then you look at the long-term fundamentals the industry has from there. So the stock is very much for the long-term fundamentals. The options, one plays options to the extent that one thinks that there is going to be a much more, there's going to be significant movement in the direction that you want. In this case, they're call options earlier than the market might perceive. And I, like any other investor, and I'll be unashamed about this, invests to make money. And I think that there is a case that the product market, that Scorpio Tankers, will recover here very fast. I mean, we can see what's happening in just the last three and a half months. That's the reason why.
Based on your most recent news, you've had some financing activities such as sale and leaseback of your ships. Can you talk about your rationale behind this? And is this something that you would also do if you needed some liquidity in the future?
Well, I don't think you can wake up and say that you need liquidity, so you're going to lease ships. I think that you're correct in your observation that we've been, doing sale and leasebacks, and that's been because we have been continually, and we said it on our last conference call, we will continue to raise liquidity, through where we can in not raising equity, through just continuously until we're completely out of this situation. And you have to anticipate that. So doing a sale leaseback can often take 2 to 3 months before that first phone call that you might make to the lease company, even if you know them very well, and the actual conclusion of the facility. So you are likely to see other expressions to liquidity measures, and I think that's the right thing to do. I think we have to remain humble. I've told you previously, I'm personally confident and willing to make the investment in that, but the right thing is to keep that balance sheet strong, keep it liquid, until that that point of inflection, as it were.
Okay, and now on the financing front, I'm going to read you a question from a reader, and it's like a 3-part question. What are the LIBOR spreads of SPDB lease financing and 47.3 million lease financing? How are the repurchase prices for ships on the various lease financings calculated, and is there any connection to market prices?
Sure. I don't think that we have, after the second question, I don't think we've actually formally announced the actual specific spread on that financing. That may come in the actual details in the earnings press release in a couple of weeks. So we'll have to wait for that one. In general, the lease financings that remain in total are somewhere in total borrowing cost, so that's the LIBOR plus the interest, between around 5 and a couple are up in the high 6s. That's the general spread. And the last question is that and that's a very important question, is how are they done? So you normally let's say we have a ship, and a ship is worth $40 million. You could do a lease, let's say, for 75% finance or 60%. So we'll take the 75% because it's Sunday morning and it's easier to do the math. So here what you do is you borrow, or you sell the ship to the lease company for 75% of its value. So in this case, $30 million. And the interest rate payments are based on the $30 million. There is then a repurchase option that's priced off the amortization schedule of that lease, just straight line. So in this case, on day one, it's $30 million. After a year, it would be less than $30 million, plus a small fee to the leasing company for the exercising of that lease. So, maybe they can be 0.5%, but I would normally say 1%, 1 to maybe 1.25%. So they're pretty efficient in that sense.
Okay, thank you.
So you have implied equity in it. So as values go up, that's how your NAVs move up or down with leased vessels with purchase options.
Okay, thank you. And then another question from a reader, and they might not necessarily rhyme with each other, but are you going to grow your fleet now that the rates are low, or will you just keep the fleet that you have in order to be able to pay back debt?
Well, I think that's a really, really good question. We can see Euronav DHT acquiring vessels with the prices being low. We can see a number of our competitors who have older fleets. There are reasons why ordering new buildings is a bit inhibitive, because really still no one knows what type of engine or combustion we're going to use. But you're going to see people acquire vessels because they have to renew their fleets. As their MRs and product tankers get above 15 years old, if they want to stay in the game properly, then they're just going to have to buy modern second-hand vessels. For ourselves, we've got a big fleet. We have the biggest fleet out there. We have we have the information. We've got a fleet big enough, especially add to our pools to win contracts, to do performance, to get market information. And it's a new fleet. We have very little capex going forward. So I think that we'll start off on the most simple thing. They're on a mathematical basis, rather than invest surplus cash flow upon a recovery to buying other vessels. Mathematically, it would be so much better to buy our own stock. In the part of the question, the first stage, you must get a rate environment first that you actually are having surplus cash flow. So in your first improvement part, maybe we'll be very gentle doing that, and the vast amount the surplus cash will start off going towards principal repayments, building up the kitty, etc. But as you move through the different rate levels into an improving market, and this opportunity remains the same between the stock price and asset value, then it would be much better to buy the stock than buy more assets.
Now the next question is on your scrubber investments. Will the scrubber investments pay off, in your opinion, as the price of oil goes up?
Well, right, they are right now. Again, so much has changed since our last conversation. I mean, the oil price was much lower. The differential between the scrubbers was, not so much. But now already, even before this week when oil price is closing in on 60, the scrubber differentials in, the LR2s were, in excess of, $2,500 a day. MRs, 1,500. That's worthwhile. That is an amazing competitive advantage. And remember, in the case of MRs, when so many of our competitors have older fleets, we start off with a ship that has lower basic OPEX costs, has lower total fuel consumption, so it's going to burn more fuel anyway, and now we're burning cheaper fuel. That's a great competitive advantage, especially in a market at the moment where it hasn't yet moved. It may have bottomed, but it hasn't yet ripped out into those positions, and especially now that I think the whole scrubber thing for us is changing now. The scrubber program, to all intents and purposes, is complete. So we don't have that cash outlay. It's gone. It's been made, and especially at this stock pricing, that benefit is really accruing to new buyers now.
When you talked about more investor interest going into Scorpio Tankers and also the tankers in general, we saw that BlackRock buying into a stake in Ardmore. So obviously this is proof that more money is flowing into the sector. And when you're looking at the rates are bad, but like you said, they're looking forward. So with that being said, Scorpio Tankers stock price is in the $14 or something like this. How does it compare to your net asset value at this point?
Well, it's a big discount. I just got BlackRock have expressed it along. They haven't just did Ardmore. I mean, BlackRock filed this week to, they may have bought Ardmore, but they filed this week to showing that they've increased their stake in Scorpio Tankers as well. So that is what we're seeing in a number of these institutions. We're seeing that interest. And on the direct question related to the NAV, the stock is severely discounting the NAV. And but I think more importantly, we've got to look at what will happen going forward. So remember, once Scorpio Tankers earns an average of around 10,000 a day, then we're actually making a contribution to amortization and therefore a contribution to NAV. I'd already indicated that we're seeing upward pressure now on yard pricing, and we are also seeing that there is going to be an interest for modern prompt tonnage. So with not many sellers, you're also getting an interest in time charter interest from traders, etc., as I pointed out. And if you then get the last component required, which is actual market improving, then those values themselves will move upwards very fast. It'll be very easy to jump up the first 10-15% or so. And if you have companies that are geared at 50% or 60% or 65%, then that 15% means that NAV will go up 30, 40, 45%. So that's a little bit in my general investor thesis towards the tankers is that not only are you buying into a steep discount of today's value, but you will get this sort of exponential growth in your NAV going forward, and that's what happens in the recoveries of shipping markets from the lows as the market recovers, and that sort of happens fairly quickly, early in the process, sort of within that first year of recovery.
Robert, if you were not running Scorpio Tankers, and obviously you're bullish Scorpio Tankers, but if we took you out of that picture from Scorpio Tankers and you acted just as an investor playing this recovery, which other companies would you look at with your experience, and why?
I would look at them in different reasons. So, I will, tell you very, openly, I don't happen to have any call options in any of the other, tanker companies. I really genuinely, either there's not the liquidity, or I genuinely think that other product tanker companies are, Scorpio is absolutely the best expression itself. I think there's two, fantastically run crude oil tanker companies out there in Euronav and DHT. I have, great respect for both of their managements and models. That they're a little bit different in the sense that DHT is much newer vessels, has the scrubbers, etc. But Euronav has, a very strong balance sheet and has consistently shown the desire to acquire back their stock and being very disciplined. So when towards the order will just be different. I think the product rates will just improve before the crude rates will. And I think even their managements themselves are, basically thinking that way, and that's sort of fairly logical. But those two companies are right now just the same as we started buying over the summer stock in Scorpio Tankers. Right now, for me, they would be very good to accumulate on a stock basis, but not yet a option basis.
I see. Thank you very much for this. Robert, I'm glad we did this again. It's been a while, but a great review and update. Is there anything else you would like to add to this conversation?
I would say that we're trying to keep things pretty simple here. And try and think forward from this, because everything, it may sound sort of so simplified, but sometimes life really is simplified. And that is, there is a huge correlation, obviously, between gasoline, consumption and jet fuel consumption and the health of the product market. And, so to me, the easiest thing to look at is just to look at these vaccinations and the behavior going forward. And that's going to be the thing that, sorts this out. And the fact that there are no inventories, the product market is much tighter than what people might think right now. We don't have those ships lying around doing nothing. So any increase in demand is going to feed through to that. And the other thing is to think what happens when OPEC starts to, most people think that the total world consumption is going to recover by somewhere between 5 and 6 million barrels this year. Well, we're already in February, so that's sort of 500,000 a month if you started in March. So imagine the psychological effect to the trading desks on the tanker companies and the traders when every week, once it starts, we know that that there's going to be more demand. Every sort of few weeks, you're going to get another announcement from OPEC or whatever on an increased position. That really changes the psychology on the desks too. And that's all I would add. Otherwise, Thank you, and really appreciate your readers' interests.
Thank you very much, Robert.
To the earnings. Thank you.